The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. This tutorial also incorporates one of the interactive Excel workbooks created as part of the Udemy course. If you'd like to purchase these interactive workbooks separately and follow along with this tutorial, you can do so by purchasing the workbooks through the link below. Welcome back. In this video, we are now going to move on to our second interactive workbook, which is accounting for stock purchases. In terms of a reminder of where we got to in the last video, our previous video, or I should say our previous interactive workbook, which was interactive workbook 1, a new business XYZ Limited was set up and the owner had injected £20,000 of cash. So we reflected that in a journal, in the trial balance and the financial statements. So we're now moving on to our second workbook, which you'll be able to download in this session's resources. So before you do that, however, I just want to introduce this transaction before you move into that. So in terms of transaction number 2, which we're moving on to, this is in the area of accounting for stock. Stock is also referred to as inventory in this case. So that is effectively goods which this company has bought, which it intends to sell on to a third party. So this falls under the area of an inventory or stock. So that stock or inventory can be used interchangeably. So in this case, XYZ have purchased stock. So in terms of the transaction here, XYZ Limited purchases and receives the inventory, in this case from a wholesale supplier. So in terms of what has been purchased, there's effectively 2 transactions have fallen within this stock purchase. So on the 3rd of June 2004, 100 units were acquired at £10 per unit, so that gives us a total inventory value of £1,000. And then on the 7th of June 2004, 500 units were acquired at £9.50 per unit, so that gives us a value of £4,750. So in this case here, I'm just going to read out a little bit of narrative or an assumption which is relevant to this transaction, and then I'm going to explain it. So in this case, the accountant within the business has deemed that it is appropriate for VAT to be included on the invoice and appropriate to reclaim the VAT from the tax authorities. So in terms of what VAT is, VAT stands for value added tax. Value added tax or VAT is the tax you have to pay when you buy goods or services. So in this case, XYZ Limited are buying a good, they're buying goods inventory here. So there's VAT on that purchase, and in terms of being able to reclaim the VAT, you can usually reclaim the VAT paid on goods and services which are purchased for use in the business. So in this case, the accountant in the business has deemed that VAT is allowed to be reclaimed, so there will be VAT paid on the invoice over to the supplier, but then because that VAT can be claimed, think what that means, there is going to be money to claim back in that VAT. So you might be thinking that's an asset, so just keep that in mind then as part of doing the accounting for the VAT and accounting for this transaction. So again, what you should do now, or in a few moments when I ask you to pause the video, download the Excel Interactive Workbook 2 and complete the following. So these tasks are the same as previous. So in tab 1, which I'll show you in a brief moment, in tab 1, construct the journal, this journal for transaction 2 in tab 1. Then move on to task 2. So task 2 is in tab 2, you have to reflect that journal in the trial balance. And then in tab 3, once you've posted that journal in the trial balance, review how this transaction looks in the financial statement. So in terms of this transaction now, I will show you what you should. So you should download Interactive Workbook 2. So that's in your resources for this session. So again, these are the tabs. So I don't want to go through these too much, but effectively, your journal template is here. So there is a transaction, the stock purchase on the 3rd of June. You have to recognize here. So posted debits and credits, and these are the accounts that are affected. So that's the VAT receivable to be aware of, and then the 7th of June item or journal then should be reflected here. So again, put the debits in one of these columns and then the credits in the relevant columns. And what happens here is that this journal will actually update automatically. So all you have to do is update the journal for up here in these relevant cells, the debits and credits, and do that the same for the 7th of June, and that will update this automatically. And then once you have posted these two journals, reflect this overall summary journal in the trial balance. So there should be debits and credits here impacted in this column for Workbook 2, and then review that in the illustrative financial statements in 3A and 3B. So that's the same story as last time. So now if you want to go back and for review the transaction, it is in this tab 4. So once you got this information, you now should be able to reflect the journal. And so if you want to pause the video and update the relevant tabs, and then in a few seconds I'll go through the solution. So pause this video now and attempt the tasks. Okay, hopefully now you've had a chance to now attempt that. So in terms of our transactions, so we've got effectively, I'm not going to go through this in too much detail again because I've already done that, but we've got a transaction here on the 3rd of June. 100 units of stock were purchased at £10 per unit, so that is £1,000. So we also have to recognise the VAT. So let's just work through this step by step. So in terms of the stock or inventory, we are told that 100 units were purchased at £10. So that is an asset. So if we go over, we need to recognise an asset here. So to increase an asset, we have to debit it. So we would debit our stock £1,000. In terms of the VAT, so we are going to be able to claim this VAT back. So that is actually an asset to us. If we were unable to claim that VAT back, we'd have to expense that. But in this case, the accountants have told us that we're going to be able to claim this VAT back. So that's actually an asset. It's a receivable to us because on our VAT return, we're going to be able to claim that back from the relevant tax authorities. So £1,000 at the VAT rate of 20% gives us a VAT rate of 200, and so that is our debits set. And then we have to recognise a trade payable because we are paying this on credit terms, so the cash impact isn't recognised straight away, but what we will have to pay to the supplier is the amount of the stock plus the amount of VAT. So we owe that supplier £1,200. So that is the accounting for this transaction on the 3rd of June. So 7th of June then, just the prices are different, but this follows the same process. So in terms of the stock in this case has been received, because the stock has been received, we can actually recognise the stock, the inventory, we have that already. So that is, we were able to recognise that. So the value of the inventory is 4,750. And then in terms of the VAT then, same story, we'll be able to reclaim this VAT. So we're just going to multiply that by 20%. So that is us recognising that VAT receivable. And then in terms of the amount that will be owed, it is these two added together, which is 5,700, and that is what we're going to have to pay across to the supplier. So let's just recognise the liability for this. So we go over to our table. To increase a liability is a credit. So we are going to credit our books 5,700, and then simply this is our journal here. So this is just basically added the relevant debits and credits. So now we're going to move on to tasks. So that is task 1 complete. That's good. We need to now reflect this in our trial balance. So stock was 5,750 of a debit. So let's just do that one first. Let's find our stock. So stock and inventory, that could be just in terms of the terminology. You can use one. We probably should be consistent. So I think I'm going to just make sure these are all inventory. So in your trial balance, in your template, these will all read inventory. So that's fine. So we're going to, the inventory was, so what we can do is press equals in terms of this Excel and then just go 5750. We can then go into the next amount to be recognized was the VAT receivable. So the VAT balance then, so this would be take our receivables and payables, but in this case we only have a VAT receivable, so our payables would reduce the amount we could claim back from the tax authorities, but in this case there is only 1,150 we will be able to reclaim in our next VAT return based on these transactions. And then the last one was a trade payable, so we want to make that a minus figure, so I just equals and then minus, and then I'm going to say minus 6,000 $6,900, which is the sum of those transactions. So we now have our trial balance, which is updated automatically. So you have now completed task 2. Hopefully you were getting that, and if not, you should hopefully be able to follow along. So then task 3 is simply review the transactions in the financial statements. So this is our financial statements in debits and credits form. So still, you can see here that our income statement has still not been impacted. So that's important at this case. At this stage, we've purchased inventory, but again, we haven't sold anything, so it's inappropriate to recognize any sales. And under the matching principle, we only recognize the cost when the sale has occurred. So in this case, it's not appropriate to recognize any costs yet. So we can go down to our balance sheet. Then we now have a balance for inventory as an asset, which is correct because we've now bought inventory and we have that on hand. Our debtors then, so debtors is amounts that are owed to us, and that is our 1,150. And if you recall, that is our VAT balance that we are going to receive from the tax authority because the VAT could be reclaimed in this instance. So that's actually owed to us. And then our cash in hand is 20,000, and that is just coming from transaction 1. We haven't impacted bank or cash in this transaction because we have purchased that on credit. And then in terms of our creditor amount, that is the amount that we owe to the creditor in terms of we purchased inventory at 5,750, and we still have to pay that VAT across because there's VAT on the invoice. We have to pay that VAT across to the supplier, but the point is we will be able to claim that back then in our next VAT return, but we still have to pay that across to our supplier, so that's why we're recognizing liability for that 6,900. And then so once you've done 3A, 3B then is just so we can delete these are not in debits and credits forms, so that will be deleted in your template. So that is appropriate there. So now we have got the financial statements as the end user would see them. So at this point, again, as I said, the income statement has not been impacted, and then the balance sheet would look like this. So hopefully you're getting that. I will see you in the next video. So we have now got our next video. We're now going to sell this inventory at some point, and in terms of the methodologies, in terms of how we should recognize the cost associated with that sale, we'll go into a little bit of detail, but hopefully you're getting that, and I'll see you in the next video. Thank you.